Next, we're going to move into talking about capital losses. So with capital losses, you can use your capital losses to offset capital gains. And also, after offsetting capital gains, you can use those any remaining losses you might have to deduct up to $3,000 of ordinary income, or $1,500 if you're married filing separately. So, for example, if you incur a $5,000 loss on the sale of an asset, and you also incurred a $4,000 gain on the sale of another asset, you can offset the $4,000 gain and $1,000 of ordinary income using that $5,000 loss. So the reason we're talking about that is because there's a very famous tax saving strategy in the crypto world. And this is actually a strategy that can be used in general, but it's for some reason taken a lot of popularity in the crypto world. And it's called tax loss harvesting. So tax loss harvesting, as defined by Investopedia, is the selling of securities at a loss to offset a capital gains tax liability. And this strategy is typically employed to limit the recognition of short-term capital gains. So it's exactly what we just said. You can, harvest your losses to offset your gains. So the reason why it's very popular in the crypto world is because of basically there's something called the wash sale. So after selling off, the wash sale states that after selling off a security at a loss, you must wait at least 30 days before buying it back in order to be able to use those losses to offset your gains. Otherwise, if you buy it back within 30 days, it's considered a wash. So you can't use those losses to offset your gains, right? But in crypto, actually, the crypto are considered a property, right? Crypto is considered property by the IRS, and property is not subject to the wash sale rule. So it's a common misconception because we typically associate, crypto trading and stock trading is kind of the same thing, but it's actually very different. So that's where the confusion might come in for some people. But again, stocks are considered securities, whereas crypto is considered property. And that's why right now it's able to take advantage of this sort of kind of a tax loophole, right? So here's an example. In September of 2021, you buy 10 units of coin A valued at $10,000. And in October, the value of the coin goes down to $9,500. The value of the investment goes down to $9,500. So then you log on to your exchange and you sell off all of your coins. Then 2 days later, you buy them back at nearly the same value. And a month later, your investment goes up to $10,500. Again, that's your total investment. So if you were to choose to dispose of your assets at that current market value of $10,500, you could offset the $500 gain, right, with the $500 loss, right? So your initial purchasing price was at $10,000, right? You went down 500, and then it went over 500. You can use the loss to offset the gains, right? But the only difference but the interesting advantage with cryptocurrency is that currently there's no minimum wait time. So you can sell it off and then buy it back. And you can still use the losses you can buy it back within 30 days and you can still use the losses to offset your gains. Is that part clear? All right. So taking this into consideration, depending on the tax lien ID method you choose, you could be looking at a different tax liability. Typically, so just to be clear, Cointelli does not offer tax loss harvesting, but we do have the best underlying technology to ensure that the customers get the best tax savings possible. All right, so that's everything for today. And if you have any questions, please leave a comment. Thank you.